So, you've made the move, the baguettes are fresh, the wine is cheaper, and the sun actually exists. Life is good. But then someone mentions tax, and suddenly that glass of Bordeaux doesn't taste quite as good. Do you still pay tax in the UK? Does France want a piece of you too? And is HMRC going to track you down even in deepest, darkest Dordogne? The answer to all three is it depends. But don't worry, by the end of this video you'll know exactly where you stand, and hopefully you can get back to enjoying that wine. Welcome to the Expat Accountant. I'm Ad, a UK qualified accountant, and I actually live here in France, so this isn't just theory. This is the stuff I deal with personally every single day. This channel exists because when I moved here, I couldn't find clear, straight-talking financial information aimed at British expats, so I decided to make it myself. Quick disclaimer before we start, this video is general information based on current rules in June 2026 and is not personal financial or tax advice. Everyone's situation is different, and if yours is complicated, I strongly recommend getting professional advice. The first thing to understand is that tax is all about residency, not nationality, not where your bank account is, not where your cat lives, residency. And this is where a lot of people make their first mistake. Many Brits assume that the moment they board the Eurostar with their removal boxes, they've left the UK tax system behind. If only it were that simple. The UK uses something called the Statutory Residence Test, or SRT, to determine whether you're still a UK tax resident. It looks at things like how many days you spend in the UK, whether you have a home there, whether you work there, and what HMRC somewhat ominously calls your ties to the UK. Family ties, accommodation ties, work ties. The more ties you have, the more likely HMRC considers you still theirs. The general rule of thumb most people have heard is the 183-day rule. Spend fewer than 183 days in the UK in a tax year and you're not UK resident. That's broadly true, but it's not the whole picture. You can actually become non-UK resident in far fewer days if you have few ties to the UK. Equally, you can remain UK resident even spending relatively little time there if your ties are strong enough. So the key takeaway here is this. Leaving the UK does not automatically make you non-UK resident. You need to formally break UK residency and ideally have that clearly documented. More on that later. Right, so what does France want from you? Quite a lot, as it turns out. France is rather enthusiastic about collecting tax. Who knew? You become French tax resident if you meet any one of these conditions. First, France is your main home, your foyer as they call it. Second, you spend more than 183 days per year in France. Third, your main professional activity is in France. Or fourth, France is the centre of your economic interests, meaning most of your income or investments are here. Once you're French tax resident, France taxes you on your worldwide income, everything. UK rental income, UK dividends, UK pensions, investments. France wants to know about all of it. I can already hear some of you saying, but they can't tax my UK income, it's from the UK. And this is where the double tax treaty comes in, which is actually good news, and I'll explain it in a moment. One thing that surprises many British expats is the French concept of the foyer fiscal, essentially the tax household. In France, you and your spouse or partner file a joint tax return together. This is quite different to the UK, where you each file individually. It can actually work in your favour if one partner earns significantly less, as income is effectively split between you. But it's an important difference to be aware of. Right, the double tax treaty. This sounds terrifying, but it's actually your best friend. Think of it as the agreement between the UK and France that stops both countries taxing the same income twice, which frankly would be outrageous even by the standards of two countries with a very complicated history. The UK-France double tax treaty has been in place for decades, and it sets out very clearly which country gets to tax which type of income. Here's a simplified overview. Employment or self-employed income is taxed where you work. If you physically do the work in France, France taxes it. UK rental income. This is one that catches people out. Even as a French resident, your UK rental income is primarily taxable in the UK. You also need to declare it in France, but you'll receive a credit for the UK tax paid, so you don't pay tax twice. UK state pension. This is taxable in France once you're French resident. Yes, your good old British state pension that you've paid national insurance for your entire working life becomes taxable in France. I'll pause whilst that sinks in. Private pensions and annuities, generally taxable in France as French resident, though there are nuances depending on the type of pension. UK government services pensions. This is an exception. If you work for the UK government, for example in the civil service, military, police, teachers in some cases, your pension may remain taxable only in the UK, even as a French resident. It's worth checking your specific pension scheme. Dividends and interest. These can be taxed in both countries up to certain limits, with credits given to avoid double taxation. The practical upshot is this: you will likely pay tax somewhere on all your income. But the treaty ensures that you're not paying full rates in both countries simultaneously. The admin of declaring in both countries is the real headache, which is frankly very on brand for both nations. Now let's talk about your old friends at HMRC. Do you still need to file a UK self-assessment tax return after moving to France? The honest answer is possibly yes, for several years at least. If you have UK source income, rental income, a UK pension, UK dividends, you'll likely still need to file a UK self-assessment return to declare that income and potentially pay UK tax on it. You also need to notify HMRC that you've left the UK. You do this through a form called the P85, getting your income tax right when you leave the UK. It's not the most thrilling read, I'll admit, but it is important. It tells HMRC you've left and they'll adjust your tax code and national insurance position accordingly. Failing to notify HMRC you've left and continuing to receive a UK personal allowance you're no longer entitled to is the kind of thing that can come back to bite you several years later with interest and penalties attached. HMRC has a long memory, and unlike the French, they don't take August off. If you have no UK source income at all, which is relatively rare, then your UK filing obligations may end, but get proper confirmation of this rather than just assuming. Right, let's talk about the mistakes I see most often. These are completely understandable. The system is genuinely complicated, but they're also very avoidable. Mistake number 1. Assuming you've automatically left the UK tax system. As we've covered, you need to actively break UK residency and notify HMRC. Just moving doesn't do it. Mistake number 2. Not declaring UK income in France. I've met people who think that because their rental income or pension comes from the UK, France has nothing to do with it. As a French tax resident, you must declare your worldwide income in France. The double tax treaty sorts out who actually collects the tax, but you still have to declare it. Mistake number 3, missing French tax deadlines. France has a relatively straightforward online declaration system, but the deadlines vary by department and by whether you're filing online or on paper. Missing them comes with automatic penalties. The French tax authority, the Direction Générale des Finances Publiques, or DGFiP, because the French love an acronym, is not known for its flexibility on deadlines. Mistake number 4. Thinking your accountant back in Oxfordshire can handle everything. A UK accountant without specific cross-border experience may not be familiar with French tax obligations or the nuances of the double tax treaty. You need someone who understands both systems, which entirely coincidentally is exactly what this channel is about. So let's bring this together. Moving to France does not automatically end your UK tax obligations. France will tax you as a French resident on your worldwide income. The double tax treaty between the UK and France prevents you being fully taxed twice, but it doesn't mean you can ignore either country's system. And the admin of staying compliant in both countries is genuinely manageable once you understand the framework. The good news is you've just taken the first step by watching this video, and if your situation is more complex, maybe you have rental properties, a private pension, investments, or you're self-employed across both countries, then I'd strongly recommend getting specific advice rather than relying on general information. If you found this useful, please do subscribe. I post every Wednesday covering tax, pensions, banking, investments, and everything's in between for British expats in France. And leave a comment below if you have a question or a topic you'd like me to cover. I read every single one. Next week, I'm covering French tax residency in more detail, specifically how to know for certain whether you're resident and what to do about it. See you then.